Our last section in the financial math module has to do with income taxes, specifically federal income taxes. A little bit of history. The federal income tax was first instituted during the Civil War in 1862 to help pay for the war, but abandoned a few years later. The 16th Amendment, though, in 1913, gave the federal government the authority to collect income tax on a regular basis, and that's basically been a part of our lives in the last 100 years or so. Now, an overview of the income tax process. When you fill out income taxes and you're working with the forms, you may see many lines where you put things in or have the potential to put things in. But really, all of those lines and all those steps in the forms really come down to 5 main steps, 5 main ideas of what you're doing. The first is that you're always going to look at your total income for the year, all of your income. That's the first thing. So you may have different lines where you actually work out and put together all the income you have earned. That includes tips, wages, etc. for the entire year. Then the federal government allows you to subtract some of that based on approved adjustments. Those can be contributions to IRAs, in other words, retirement funds, and other things. So there's a list of things that you can adjust your income by. That means subtract it off. Then there's one last step that you can actually work with to reduce your income in terms of how much you're getting taxed on, and that is through deductions. So you may have heard of deductions or actually worked with them. You have 2 options with deductions that we'll look at: standard deductions and itemized deductions. Deductions can come from charitable contributions. They can also be medical expenses that you can deduct. So you actually aren't going to be taxed on your entire income. You start with the entire income, but you adjust twice with authorized deductions and adjustments to create what we call the taxable income. Once we work out how much the government is actually going to tax you on, how much of your income they tax you on, then you'll actually calculate the tax. And usually you calculate the tax by using a tax formula or a tax table. So you'll actually work out, based on your taxable income, how much tax you owe. Once you've done that, the federal government will allow you one more time where you can maybe make adjustments to how much tax you have to pay. These are often called credits. We can subtract any credits from our tax that we owe. Some people have multiple tax credits that they're allowed. Other people don't have any. It just depends on your situation. At that point, you're going to work out whether you still owe tax or you're allowed a refund. And you might say, how are you allowed a refund? Well, the thing is that most people pay tax throughout the year in anticipation of what they owe, what's called withholdings from your paycheck. So you may have already paid all of that tax and be owed a refund, or you may not have paid enough during the year and you may have extra that you owe. So there's basically 5 steps that take you from looking at all of your income to determining whether you get a refund or you still owe a little bit more. Let's clarify some of the vocabulary we're going to use related to taxes. Gross income is the total of all your wages, tips, income from interest, like in a savings account, rental income if you happen to own properties and rent it, and dividends for the year. So it's all of your income. Gross income is another way of saying total or all of your income for the year. Now we adjust that, and we call that the adjusted gross income. AGI is your gross income minus any adjustments that the federal government allows. Those adjustments could be from contributions to tax-deferred retirement accounts. That's probably the most common. Then we have our taxable income, which is our adjusted gross income minus your deductions for the year. Now, there are 2 ways you can do deductions. There's a standard deduction for each filing status, and then there's an itemized deduction that you can take where you actually work out how much you've paid in state and local taxes, for instance, property taxes, medical expenses, union dues, mortgage insurance, charitable donations. There's a lot of different things you can take deductions on. And you can itemize those. That means actually list them out individually to work out what your itemized deductions would be. What generally people do is they compare, once they've itemized, how much their itemized deduction would be compared with their standard deduction for their filing status, and take whichever is larger, because you want to take as much deductions you can to reduce your gross income as much so that you get taxed on less income. So deductions help reduce how much you get taxed by. Now, I mentioned that your standard deductions are based on your filing status, and there are actually 5 filing statuses, and your filing status is determined by your personal situation. If you are single, and that includes being divorced, your standard deduction in 2022 is going to be $12,950. Okay? The idea is you're basically taking care of one person, yourself. You can, if you're married, file in 2 ways. You can have a filing status of married filing jointly, in which you and your spouse file a single tax form together. And your standard deduction, if you're married and filing jointly, would be $25,900. That's actually double what the single standard deduction would be, because you are filing as a couple, as 2 people. So it makes sense that the standard deduction for 2 people is double what it would be for 1 person. The other way you can file if you're married is you can file as married filing separately. What that means is that you and your spouse each separately file tax forms. And if you do that because you're filing for 1 person, your standard deduction goes back to that single amount, $12,950. And again, these are standard deductions for 2022. They do change every year. So if in your homework, I think the My Open Math uses 2018 right now in the first edition of the book. And with the 2018 standard deductions are a little bit lower than this, because as time has gone on, we've had inflation. The other 2 ways you can file is as head of household, which means you are single, but you are the person who is contributing the most in your household to the upkeep of the household, and you have someone you're taking care of, some kind of dependent. That dependent could be a child, or it could be an older parent. So as head of household, that means you're single, but you are taking care of people. And you'll notice that the standard deduction is a little bit higher than someone who is single, because you are taking care of someone, but it is not double what it would be for filing jointly, because you're 1 person. The other way you can file is as a qualifying widow or widower. And this is something that you're allowed to do within 2 years of losing your spouse to a death. And notice that that filing status is the same as married filing jointly, because the idea is you may still have expenses related to 2 people within that 2-year window of losing your spouse. And so your standard deduction is representative of having 2 people that you're filing related to. All right, so those are the 5 filing statuses. And again, your deduction can be based on that filing status, the standard deduction, or you can itemize. There's one last definition I wanted to talk about, and that is tax credits. Tax credits allow you to reduce your final tax bill. Examples of tax credits include educational tax credits, child tax credits, energy tax credits. So the federal government wants to encourage people to buy energy efficient devices, and so sometimes they'll have tax credits to try to encourage that. Adoption credits, they want to encourage people to adopt, so you can get a credit for that. So tax credits are another thing that can help reduce your tax burden. All right, let's take a look at deductions and tax credits. Both of them help reduce how much tax you pay, but they do it in different ways. All right, so tax deductions happen to your income. So you reduce your income by subtracting deductions. And this is all going to be prior to calculating the tax. So this happens prior to calculating tax, whereas tax credits reduce your actual tax that you owe. And it's a direct reduction. So tax credits reduce the tax, whereas deductions reduce your income prior to you figuring out what your tax is. So let's use an example to compare. Let's say we have a $200 tax deduction and a $200 tax credit, and that you're in a 22% tax bracket. Remember, the tax deduction is going to reduce your income. So with a $200 tax deduction, you have a $200 reduction in your income. Now your income is being charged at 22%. So this $200 reduction in income leads to a reduction in tax of 22% of that income reduction. So 22% of 200. If you calculate that, that ends up being $44. So your tax is reduced by $44 when you have a $200 tax deduction. Again, that's because the deduction is actually to your income. Even though we call it a tax deduction, it's actually a deduction of your income, which does result in a reduction of tax you pay, but it's not $200, it's $44 for a 22% tax bracket. A tax credit, though, is a direct reduction of $200 in taxes. So we actually get $200 taken off our tax bill directly when we have a tax credit. So whereas with a $200 tax deduction, we get $44 removed off our taxes. So there's a big difference when you think about tax credits and tax deductions. They both reduce your tax burden, but in different ways. So be careful. $200 tax deduction is not a $200 tax credit. They are not equivalent. You have to think about what the adjustment would be based on your percentage tax bracket if you're dealing with a tax deduction.